Welcome to the Cherry Beckert Tax Beat, a conversation about tax that matters.
Welcome to this edition of the Cherry Beckert Tax Beat podcast. The Employee Retention Credit, or ERC, is in the news again. Some good, some bad, and some just news. Any way you slice it, is one of our favorite tax incentives of all time. It brought much needed relief during the COVID dark days, but there's continued to be abuse in this industry. The Wall Street Journal has published an article earlier this week focusing attention on the intense marketing used by some firms to attract employers to claim the credit. They've also had the IRS release limited guidance on certain key requirements to qualify for ERC. And the IRS has announced that credit unions are eligible for ERC claims as well. But all in all, there's a lot of scary news out there about the bad players in this industry. So we're going to get the good players in the industry on this call today. So joining us is Mr. Martin Karamon, partner and leader in our tax credits and incentives advisory practice. And Marty has continued to devote an awful lot of his attention to ERC and leads our team of professionals helping clients file and defend ERC claims as well. So how you doing today, Marty?
I'm doing really well. A lot going on this week in ERC and in other matters, which we're going to talk about some next week as well. But I'm happy to talk to you today.
All right. Whereabouts are you sitting today, Marty?
Today I'm in my home in Roslyn, Virginia.
All right. The Roslyn home.
The Roslyn home, correct.
All right. And as always, joining me, my partner in crime, Sarah McGregor in Greenville. Miss McGregor, how's life treating you?
Hey, Brooks. Hey, Marty. Life is good here in Greenville. It's Friday afternoon. There's tax news developing, and it's great to be talking about tax again. We got a deadline coming up, too, so that's always refreshing. Screaming into a deadline, sideways, backwards, exhausted, having taken care of a lot of clients. It's always fun times.
Yeah. And I'm Brooks Nelson, sitting here in Richmond. I'm excited about all the sports going on. My Baltimore Orioles are leading their division. My Carolina Tar Heels beat up on Sarah's Gamecocks in opening day college football. So UNC can get their disillusioned hopes up once again, only to have them smashed. And anyway, lots of fun things. Started NFL last night. All good, all good. All right, so let's jump into ERC.
Well, Marty, we've got some news out of the IRS. On September 14, the Internal Revenue Service announced a moratorium on the processing of new employee retention credit claims. Those are ERC claims until at least 2024. So between now and the end of the year, they're going to stop processing claims. What can you tell us about this rather dramatic position the IRS has taken with these ERC claims?
Absolutely. It was definitely big news in the ERC world. And I actually empathize with the IRS a little bit here. I think what they're trying to do here is twofold. One is to protect taxpayers, and they're putting out some warnings as well to keep in mind what it looks like when you're being approached by somebody who has, we'll call it, fraudulent or unscrupulous like tactics with respect to trying to get you to file an employee retention credit. They have such a backlog and they're constantly being flooded by so many claims that they're just taking a break for purposes of probably, in my opinion, developing some new processes to better comb through exactly what is being sent to them. So what that means is that, yes, there is a current moratorium on the processing of employee retention credit claims.
Does this mean that employers should stop filing ERC claims?
It does not. And what it means is that really they should make sure that they're working with a reputable provider as they assess whether or not they truly qualify for this. You can still file for an employee retention credit claim and it will be accepted by the IRS, but they will not process it at least until January 2024, as they've said. So I think they're taking their time to assess what they've gotten in from a fraudulent perspective, they feel, and what they need to do in order to better process these in the future for taxpayers. So what it really means is that twofold. One, they're not going to process anything right now. And then two, it looks like as they start to process things, it's going to be slowed down a bit as well. We were seeing refunds from anywhere from 4 months to 9 months. I would expect them to be back to the 9 to 12-month time period after this begins to be processed again later.
Right. Well, I know this isn't all we want to talk about with ERC, so let's turn it over to Brooks.
As I said, Marty, there's been a lot of negative news about it. You know, and that's really a shame because it was such a positive thing and it served such an important purpose in it, you know, in the height of COVID. But anyway, here we are. So give us a rundown. Maybe we should just backtrack. You give us a rundown on the basics of ERC 101.
Absolutely. So the employee retention credit, if we all know, is a refundable payroll tax credit. So it's a payroll tax refund provided by the IRS. And there are 4 separate employee retention credits. There is one for the period of March 2020 through December 2020, and then one for each of the first 3 quarters of 2021. All 4 of those employee retention credits, the qualification criteria is essentially determined upon whether or not a taxpayer or employer, in this case, had one of 2 things happen to them. One, they either suffered a significant decline in their gross receipts in any of the quarters of 20 compared to the same quarters of 19. And for the 20 credit, you need to have a more than 50% decline. And then for the 21 credit, if you suffered a significant decline in gross receipts, it's measured as a more than 20% decline in each of the first 3 quarters of 21 compared respectively to each of the first 3 quarters of 19. So that is basically a test to see whether the government orders that were put on the economy, the COVID-19 orders limiting commerce, travel, and group meetings, if those orders affected your customer base in a way that qualified you, you can measure that by showing a significant decline in gross receipts. Alternatively, you can qualify by having one of these COVID-19 government orders apply directly to your business and cause what's known as a partial suspension. Essentially, you need to show that a more than nominal portion of your business was suspended as a result of these COVID-19 orders. It's very important that these be COVID-19 specific orders, not just general CDC or OSHA guidance that had been out there previously and continues after. But those are the 2 ways to qualify. And the maximum credit for the 2020 credit is $5,000 per employee, and the maximum credit for the 21 credits are $7,000 per employee for each of the quarters.
So, Marty, earlier this summer, we finally got some guidance from the IRS, and including some examples they provided about employers and their suppliers, where the government mandates were applied to a supplier and how that might have affected an employer, and could they meet this this partial suspension or full suspension of the business. I think this has been an area with a lot of confusion. So can you talk about some of that guidance?
I can, and this has been an area of both confusion, and this is where a lot of the abuse is happening. The supply chain disruption argument was actually put into discussion by the IRS itself in its original FAQs. It was intended to apply, at least the way they wrote the example, to essential businesses that were not affected directly by COVID-19 orders, but rather perhaps one of their suppliers was affected by a COVID-19 order. And then sort of by a transitive property, the employer itself would then suffer a partial shutdown as a result of its supplier having a partial shutdown. It's nowhere in the CARES Act. It really is only in the IRS FAQs and then later in the IRS notices. So the IRS really created this potential position. And then what we saw is a lot of employers and really a lot of what we'll call these ERC mills perpetuating the theory that, well, there were so many supply chain disruptions out there during COVID, everybody qualifies. And so what has happened, thankfully, is that the new GLAM, which is a memorandum internally released, but by the IRS, technical memorandum, essentially what it does is provide 5 examples that are really good guideposts. And I'm happy about them because we have essentially, for our clients that have claimed supply chain disruption as a partial suspension, we've really been within the purview of what these rules say. And so if you like, I can go through some of the examples of what was not a partial suspension based on supply chain disruptions. Essentially, there were 5 examples in there, and none of the examples showed a qualification criteria. What it showed was that in one case, the supplier vaguely confirmed that there was a delay due to COVID-19, but they didn't cite any government orders on the suppliers. Another was they just focused on some news sources that said that there were supply chain disruptions, but there were no government orders. Another one indicated that you did have a supplier that cited, or a taxpayer that cited COVID-19 orders on its suppliers, but it had enough extra inventory, and so therefore it didn't really suffer a partial suspension. And then in the final example, there was the showing of a COVID-19 order on the supplier, but the company sold so many different goods that it was really just on not even a nominal portion of its business that the supply chain disruption was experienced. So the takeaway is, when you are looking to see if you qualify based on supply chain disruptions, identify who the suppliers are, identify where they're located, identify specific activities, specific government orders on these suppliers, and then find some mathematical disruption based on changes in lead times, perhaps changes in the amount of revenues associated with a certain type of good that this supply goes into. You can still qualify under the supply chain disruption theory, but you really need to document it well.
So this is more than just a conversation or an idea. You've got to really back it up with how the supplier was impacted, and then with a specific government mandate, and then how that loss of source from that supplier impacted you, the employer, and made your business have to shut down because you couldn't get the parts or the that you needed, or services or whatever that you needed to keep your business going as a result of that, even though you may have been allowed to continue to operate your business because this supplier was affected there and that supplier was critical to you. You were held up and faced that disruption there.
And in it, that's exactly right. And in addition to that, one thing that these new this technical memo makes clear is that the duration of the eligible employer status time period is only as long as the government orders are in place. To the extent you continue to have disruptions after those orders were lifted, because it takes a while to get moving again, it doesn't matter. It really is only as long as the government order COVID-19 was in place.
So the government order on the supplier was only in place for 2 months, but the employer felt the impact of those loss of supplies for a period of 6 months till you got back up to full strength. Only 2 months of that time period would actually be eligible for you to consider.
That's exactly right, because essentially the government is paying employers back for it putting brakes on the economy, but you can only measure it as long as those brakes are actually on the economy. It's hard to measure it afterwards.
Great. Well, Brooks, I don't know what else you could ask him after I just asked him all those questions.
Well, why don't you give us an example or two that you think are innovative uses of the supply chain that do qualify for ERC?
Certainly. I don't know if they're innovative as much as just we did our homework. I'll put it that way.
Okay.
Yeah.
Either way, yeah.
I think it's, we've seen it in the auto dealership area where auto dealers, two things happened. One, they in 2020, there was we'll call it a COVID-19 order on the showroom that was lifted by 2021. And then government orders on some of the foreign producers of their goods that were coming in, and orders on the ports as well, caused supply chain disruptions. And you saw quite a number of government orders on foreign ports, some US ports as well, and then also on foreign manufacturing areas as well, both specifically like in Asia and in Mexico. So that's one area where we use supply chain disruption. And we don't use it every time, right? It depends on who the dealer is. It depends on what they had in stock. It really is case by case. And so sometimes it will only last for a period through Q1. Sometimes we may be able to go through Q3 of 2021. I've also used it, or we had a taxpayer posit the theory that as an importer of foods from outside the U.S., almost the same thing. They couldn't get the goods for a period of time, and because of these delays, they couldn't. They went down to like just a very few types of foods that they were serving or able to sell, as opposed to the large variety that they had previously. So they suffered a good amount of disruption on their entire catalog of different foods that they would sell within the U.S. Those are two examples right there that I can think of.
So in addition to the that memorandum regarding suppliers and employers, the IRS also posted some new items to their frequently asked questions on their website, irs.gov.
Yeah, that's right. And what you see there is there were FAQs previously when the 2020 credit first was put into law back in 2020, and those later were just referred to as only historical documents. And so this provides a little bit more updated Q&A FAQ. Everybody loves an FAQ, right? And so it really provides some good examples in there. So I think that's just another resource that we can look at. There's actually been quite a bit coming out, both from the IRS and some other practitioners as well, working with the government right now, which we can talk about specifically if you'd like as well.
IRS also released some final regulations, Mari, that get into this issue of aggressive marketing ERC, and they specifically get into recapturing erroneous ERC claims, as well as some other pandemic era payments. So what does this really mean in the ERC world, and what are your concerns?
Okay, so this is interesting. I can actually think of three things right now based on what you just said. So the first thing is that on May 25th of 2023, the IRS released its Dirty Dozen, which Dirty Dozen tax positions, tax scams that are out there, ERC being number one. And the reason for that is because so many companies are getting aggressive pitches, unsolicited calls. They're being charged large upfront fees. They're trying to put people on notice that and the employee retention credit has a lot of players out there, and you can identify them often just if they have ERC in their name, that are trying to get businesses to give them their business and get them to qualify based on very baseline guidance around what it makes to be an eligible employer. What they're really doing is giving taxpayers a very general description of the employee retention credit, and then asking the taxpayer to certify that they qualify, and then relying on the taxpayer's certification to file an employee retention credit, or at least to calculate an employee retention credit for them. That's something to look out for. And I would say, if you're going to claim an employee retention credit, or if you're talking to somebody about doing it, do it with someone who can actually file and sign the tax return with you, the amended Form 941X. Beyond that, the IRS in July clarified in new regulations that overpayments under the employee retention credit would be treated as the same manner as an underpayment of taxes. And what they also clarified is that if you use a PEO that files an ERC on your behalf, both you as a taxpayer and the PEO are liable as potentially having an underpayment if you received an overpayment of ERC to which you were not entitled. So I think that those are two of the three things I wanted to mention right there. I think the third is that in July as well, there was a really good hearing in front of the Ways and Means Committee, where they had two practitioners, one representative for PEO and another representative from some nonprofit organizations, that testified about all the confusion that they had seen in the industry and had seen around the credit. And what we got out of that really is that it seemed like Congress and the IRS are quite amenable to the idea of allowing companies to file ERCs in an electronic format where they have not been able to before. So we may see some change next year with the ability to file electronically as opposed to previously, because there's a huge backlog of employee retention claims right now.
All right, Marty, anything else you'd like to add going on in the ERC world that we haven't covered yet?
Yeah, maybe two things. And one is, don't be afraid to claim the employee retention credit or investigate it if you really think that you qualify. It's worth taking a look at this. It is a lucrative incentive, and many people do actually qualify for it and have gotten refunds within the period of like 9 to 12 months after they filed. We did see in this Wall Street Journal report recently that the IRS is slowing down the way its refunds are being given in order to maybe combat some of this fraud. What I have actually seen is the IRS actually speeding up on its payments right now. So it seems like they're through some of the backlog. So I wouldn't be afraid to claim it. Lastly, to the extent you are a tax preparer of income taxes, it should be known that if your client filed an employee retention credit, they actually technically have to go back and file an amended return specific to the year that the employee retention credit relates, and you have to reduce your deductions for wages. The Office of Professional Responsibility came out in March and indicated that if you are not confident as a provider of income tax preparation that the employee retention credit is correct, you're essentially perpetuating the fraud by going back and amending the return and reducing those deductions. So they're putting those on notice who are not only those that filed the ERCs or the consultant who did the ERC consulting, but rather the income tax preparer that they, from an Office of Professional Responsibility perspective, may get in a little bit of trouble there by perpetuating the potential fraud that was out there.
That just seems awfully hard on the tax preparer if they're not associated with the ERC claim. I mean, in general, it's conservative to go back and amend the return and reduce your wage deduction, which increases your tax. So you're trying to be, I mean, I think in many ways you're trying to be a good steward for the government when you do that. And then to sit there and say the claim's bad, but you're on the hook because you tried to follow your end of the law. That's, I don't know. I have a hard time.
It would be a rare time or in history where someone is trying to reduce a deduction and therefore being accused of perpetuating some kind of fraud. Yes. But the rule's out there, and I understand where you're coming from as well. Yeah. And how it's enforced it will be seen.
Yeah.
Right. There is a lot of conversation about that release and what it means from a professional perspective and what is our responsibility. And so I think that surprised a lot of folks to see that
it's just
out there.
What it's meant for us, though, is a lot of good conversation within the firm. So whenever we see an employee retention credit amendment necessarily being contemplated, even if we didn't prepare it, we still do a review there and can actually provide good advice back to the client. And at times, we've also found some that the client has gone back and reversed their position and given the money back or put in another amended 941. So it's provided us the ability to be a consultant to clients that we didn't work on for ERC, but for whom we do the income tax return.
All right. Any concluding comments, Marty, on your side?
I would just say, please reach out to us if you have any questions about the employee retention credit. We are more than happy to go through your fact pattern and provide as much advice as you need in order to make sure that you are either claiming it if you haven't yet, and you should, or perhaps if you claimed it with someone else and what some of the risks may be.
All right. How about you, Sarah?
Well, just a reminder that we still have until next April to file for the 2020 ERC claims, and 2025 to finish filing for, whichever way that goes. 2025 to file for the ones for 2021.
Yeah.
So there's still time to go back and make sure we're picking those things up, or to fix things if you think you've gotten a deal where you may not be feeling very positive about the work that another firm did on an ERC claim or didn't do, as the case may be.
Right. Well, I'll just echo something I've said before, that the longer ERCs are around, the more nuanced and the more technical it gets. When you get outside of the realm of the direct, reduction in sales calculation, the complexities seem to get more and more, and then add to the nuances, the deduction rules, and everything that goes along with that as well. Okay. Yeah, call Marty. I guess that's my
very good
conclusion. There we go. All right. That's a wrap on today's discussion on ERC updates. Thank you for listening in. Quick disclaimer that we're not providing tax advice on this podcast. Please consult with your tax advisor, hopefully at Cherry Beckert, with your specific tax issues or to discuss information from today's podcast. Check out the firm's website at cbh.com for the latest guidance and materials on this and other tax and business topics. This concludes today's podcast. Please like, share, and subscribe. Thank you, Marty. Thank you, our listeners, for spending your time with us. We truly appreciate it. Let's call it a day and go forth in peace.